Sheila Bair joins us now. Great to have you on today. Thanks for being with us.
Thanks for having me.
I want to get your reaction to the testimony we got, including that exchange we just played.
Right. Well, I'm really glad he asked the question. It's a good question, one I've been asking for over a year now. The Fed hasn't stressed rising interest rates since 2018 in their severely adverse scenario. And I must emphasize, this is true for all banks, including the multi-trillion-dollar GSIB, what we call the GSIB banks, the most systemic banks. This isn't a problem unique to these mid-sized institutions. These stress tests need to focus on interest rate increases and the market losses that are causing, and whether there's capital adequacy to absorb losses. If they're in a very distressed situation, they have to sell those assets that have lost market value. So I'm really glad he pressed him. I feel bad for Michael Barr. He wasn't involved in those former stress tests. He owns the one this year, which also doesn't stress rising interest rates. So maybe now he'll correct that. But he's kind of coming into this without having been involved in some of the decision making of the past that could have been better, especially on the risk of interest rate increases.
Another big related topic of the testimony of the hearing today was this notion that mid-sized banks need stricter regulations. And as you did hear, those regulators all agree that that is something that should probably happen. You did see bank stocks move lower. Do you agree? And if so, what would stricter regulations look on these regional banks?
Well, again, we have a problem with all the banks that not doing an adequate job of stress testing interest rate increases. For the mid-tier banks, they did get some special breaks that I think need to be revisited, but those are targeted things. I don't want people to get this idea that somehow there was some vast deregulation of mid-sized banks. That's not true. The vast majority of them are quite healthy. They're a backbone. Regional banks are a key part of our banking system. We're very healthy during the great financial crisis, so people shouldn't get that idea. A couple things. I think they probably do need annual stress tests. Stress tests for all banks need to include interest rate increases. If you're below $250 billion now, it's every other year. That's probably not enough. I think, again, for all banks, too, some of these mid-sized banks have a special break in terms of when they have to mark-to-market securities that they hold in what's called an available-for-sale portfolio. That means they think they might sell them, but they still don't have to mark them and deduct that from capital. That should change. Banks should have to do that. Large banks have to do it now. The mid-sized banks should, too. So those are discrete areas. But I think overall, we don't need a raft of new rules for mid-sized banks. The sector is quite healthy, and people should not be worried.
So, Sheila, you mentioned that Barr was not responsible for the stress test. But last week on Overtime, we had Randall Quarles on. He was the vice chair for supervision at the time. He pointed to this tech-driven increase in the speed of bank runs as being the real issue here. You agree with that?
Right. So I think it was a factor, but that does not really, that kind of begs the question of what happened here, which is a fundamental failure of basic interest rate risk management by management. The management of these banks bears the lion's share of responsibility. But examiners were not vigilant. And again, the stress testing process is not focused on that. So, yes, does it speed up the risk of bank runs? Yeah. But still, this was Silicon Valley in particular. This was a very close-knit community. They talked to each other all the time. They didn't need Twitter to get the word out. They were running. And that's exactly what they did. So with Silicon Valley in particular, I don't think social media was that big of a factor in the bank run.